on what needs to be done on the official agenda, and then I'll move quickly on to sort of non-official agenda. Clearly, there's the implementation of so-called banking union. I was mentioning that the fact that the resolution authority, so-called single resolution board in EU needs to start working. Another dimension which is very important and which I see in my job as regulator is that there is a big need in the EU for regulatory and supervisory convergence because EU directives and regulations, in theory, same rule for everybody to make things simple, even though directives are adapted to local specificities or member state specificities, but in a nutshell, they're similar regulations. The reality is that regulators actually implement those rules in a different manner, which is normal. You have 28 countries, you have 1, 2, 3 regulators per country. Just think what that means. I mean, this is not trivial. And obviously, supervisory convergence is absolutely essential because, for obvious reasons. I mean, if the police doesn't apply the rule the same way in country A and country B, guess what's going to happen where the police is applies the rules in a less strict manner. So this is something very high on the agenda of supervisors and regulators. They're all working on that. The 3 European supervisory agencies, European Banking Authority, European Securities Market Authority, and EIOPA, which is the Insurance and Pension Authority, have a mandate to work on that. It's happening as it happens in the real world, i.e. things take time. So if you want to be optimistic, say, hey, give us a little bit of time, which is fair enough because it's such an ambitious project. And if you want to be pessimistic, you can spot a number of things where much more needs to be done. And there's more legislation to come. Money market legislation, which is a big issue for so-called shadow banking, still needs to be adopted. I'm very pessimistic that we're going to adopt anything significant. And obviously there was the proposal put on the table by the last European Commission at the end of January to reform the structure of banks, was put on the table by Commissioner Barnier at the end of January. Jonathan Hill, the new Commissioner of Financial Services, said he would take it up. So apparently we're going to have a debate on should we, to make a much longer story short, should we split banks, yes or not, or no? So that's going to come up again, and a number of other issues on repos and special financing transactions. One last word, if I may insist, on banking union. I've said that it is a progress, and I do believe it's a progress. I think one of its limitations is that for the time being, it deals with very large institutions. And of course, very large institutions need to be dealt with. But contrary to what is happening or what has happened, in particular under Glass-Steagall in the US, and we all know that Glass-Steagall, well, okay, prohibition of investment banking for commercial banks, one thing, but the other thing which is less often discussed is that Glass-Steagall created the FDIC, which is the resolution authority in the US for small and medium-sized banking institutions, deposit-taking banking institutions. And what's really interesting in the US experience is that you see that a proper resolution framework, as you can see it in FDIC, works well for small and medium-sized institutions. There's about, for the past 5 years, there's been about 90 bank failures in the US per annum. Vast majority of them are for banks that have a size of 20, 30, or 40 billion dollars, which is more or less 1% the size of our European giants. So you see, the difference in size is just tremendous. But for that sort of institutions, a proper resolution framework can work, i.e. a framework that allows failure. And I believe that a system where failure is not allowed is a dead system. So the issue today is not to say no bank should ever fail. A, that's not realistic, and B, it will just kill the system. It will prevent people from having that activity activity that we need to make the economy work. The problem is to make sure that when a bank fails, and banks will fail in the future, it doesn't take the whole system down. And what I believe the US experience can teach in the EU is that for medium or small size banking institutions, you can build a resolution system that can cope with the failure of a number of banks. And bear in mind, there is more or less 2,000 banks in the US, so 90 out of 2,000 failing, well, it's, you know, it's a proportion, but the system carries on, doesn't cost money to taxpayers, doesn't make depositors lose money. As far as I'm concerned, it's the proof that a resolution system can work. Weekend time? Yeah?
A few more minutes?
Yeah. This is for, you know, what's actually been done. Another dimension that I would like to mention now is the underlying assumptions that are used for financial regulation. Those assumptions, and I will give you a few examples, I feel are completely ignored by the vast majority of people involved in financial regulation, and they make the whole system very, very fragile. The entire regulation is actually built without even realizing it on a number of assumptions that are wrong, and if you as academics, and I would say we, you know, as people who sort of push the message to policymakers, do not make them realize we will be, and we are actually building a system that doesn't function and that will not achieve the purpose it's meant to achieve. Let me give you actually 3 examples. I was going to give you 2 examples, but one of them was discussed with Giuseppe and a number of other people yesterday. First example of an assumption that underlies our financial regulation and doesn't work is the risk weight system in regulatory capital regulation. We mentioned it earlier. Concept of risk weights at the heart of Basel III is actually based on the notion of value at risk. This is a major concern, as value at risk is a method that may have some merits in normal times, but that has proved to be completely useless in times of crisis. We saw in the last crisis that we had 25 standard deviation events happening 3 times a day. I don't need to tell you that, you know, this is not exactly like normal. So despite that fact, we're still basing all the calculations to work out the capital that banks should issue on a methodology that actually doesn't work in times of crisis. Here again, perhaps a fair approximation in normal routine times, doesn't work in times of crisis. Problem, obviously you need capital for times of crisis. You know, that's precisely when you need capital. So we use a methodology that doesn't work in times of crisis to calculate what we will need in times of crisis. And this is something that is absolutely striking. And go to regulators, go to legislators. Legislators, they just even don't want to hear about it. It's like, oh, this is a refinement for, you know, the academics, and, you know, they love to make very fancy things, but, you know, we're very pragmatic and it works. No, it doesn't work. It doesn't work. I've had the opportunity to discuss it with a number of central bankers or high-level banking regulators, and they will admit behind closed doors that the argument is true, and that no trader, no option trader who basically use similar models will use those models when there's a crash. You know, the day there's a crash, an option trader, a long time ago was an option trader, just doesn't turn the computer on, because that day all you want to do is go short the market and forget about theoretical value. Okay, and you go to banking authorities, you tell them, look, you know, this doesn't make any sense. They will admit, and they admit behind closed doors, that this is true, but they're in a system where we've been talking like that and thinking like that for years and years and years and years. We're not going to change it now, are we? This is, and I relate it to the work you're doing, where you have such an important role. You need to pass the message and repeat it again. Guys, you're building regulation on things that do not work. We have to say once again that our US friends have done a better job at that, because as Jan was mentioning, a number of regulators in the US have been saying, look, IRB, risk weights, we see the limitations, good old crude leverage. It's not perfect. No, it's not perfect. It has the merit of being simple and you can follow. But this is typically where you have to do things. Efficient markets. The efficient market hypothesis, which I don't think I need to discuss here to say what I think of it, is still an argument being used all the time in policy-making circles to justify measures discussed, negotiated, adopted. Typically on the so-called MiFID, i.e. financial market regulation debates, each time you were discussing high-frequency trading, each time you were discussing commodity derivatives, each time you were discussing MTFs and OTFs, which are two versions of these swap execution facilities that the Europeans have adopted. Each time you had debates in public, here again with policymakers, of you're going to make markets less efficient, so therefore it will raise the cost of capital, therefore companies will finance themselves more expensively, therefore you will diminish growth. End of story. Demonstration made. Those wrong assumptions are the basis of everything that is discussed. And it strikes me that there is a huge discrepancy between, I would say, all the good brains who've analyzed that it doesn't work, and the guys who make the decisions that seem to completely ignore that. I was presented in my job as a board member of the French regulator recently with an academic paper, a so-called academic paper. I don't think there is any such researcher in the room, but what I would call tobacco professor. In the Brussels jargon, a tobacco professor is someone paid by the industry to say what they want, and that's linked to that's typical Brussels jargon. If someone calls you a tobacco professor, it's not exactly a compliment. It means you just say what you've been paid to say. And that presentation was explaining to the regulator of the country, that thanks to high-frequency trading, before markets were efficient with a time lag of 1 second, and now thanks to high-frequency trading, markets were going to become efficient with a time lag of 1/100th of a second, and therefore it was such a big improvement, and we're so happy to have such improved efficiency in the market. Where do we start? So those arguments actually come to the people who are in charge of deciding on rule A or rule B. The voice must be heard. So the point I'm making here is that if you base financial regulations on flawed assumptions, even if they're adopted by non-captured, honest people who are willing to do good, they will not work. And I'm really afraid that today we've adopted a number of regulations that effectively will not achieve, and I go back to my initial definition, the two objectives of bringing capital to productive use and be making sure that the whole system doesn't collapse when a particular financial institution goes under.